You have probably seen the headlines popping up everywhere. The government is supposedly giving a free $1,000 to newborns. It sounds like a gimmick, but it is completely real. This is a legitimate program passed under the 2025 tax law, and right now, millions of American families qualify for the money. While the headline is simple, claiming those funds involves a specific set of rules that the news reports usually leave out. So we are going to break down exactly what these Trump accounts are, who gets the initial seed money, and the specific steps you must take to claim it. Knowing this fine print is the only difference between securing a $1,000 head start for your child and missing out on the benefit entirely. Let's look at the basic structure. A Trump account is a new savings program. It is designed specifically for children who are U.S. citizens, under the age of 18, and who have a Social Security number. There is a common assumption that this works like a standard checking account with a debit card you can use right away. But in reality, it's a locked, tax-deferred investment portfolio. As this umbrella shielding the growing line graph shows, tax-deferred means you do not pay tax as the money grows. You only pay those taxes later on, when the money is taken out. And if you are wondering why you can't open or fund one of these accounts today, it's because they do not technically exist yet. The official program launch is in the summer. No contributions can be made before July 4th, 2026. This means the program is a long-term investment meant for your child's adulthood. It isn't intended to pay for today's daycare or diapers. Now, let's talk about the exact requirements for the $1,000 government seed contribution, because not every child receives the bonus. This timeline shows exactly who gets the deposit. The $1,000 is exclusively reserved for children born between 2025 and 2028. Kids born before 2025 can still have an account opened for them, but they receive no seed money. If your child falls into the correct birth years, that $1,000 is a true bonus. It does not count against any future annual contribution limits your family might decide to make. A child's exact birth year creates a rigid divide. It separates the kids who receive a taxpayer-funded Head Start from those who simply gain access to a new tax account. One of the biggest misconceptions of this program is that it happens automatically. In truth, the government will not mail you a check or open an account for your baby on their own. You have to take the lead. As this diagram shows, there are 3 distinct ways to claim the account. You can file IRS Form 4547 alongside your 2025 tax return, you can register on the website at trumpaccounts.gov, or you can use the official mobile app. Because this account is so valuable, you might run into a situation where multiple family members, like a parent and a grandparent, try to open an account for the exact same child. You have to communicate and manually navigate this process. If you assume the government handles it for you, you permanently leave a $1,000 benefit sitting on the table. To prevent family conflicts over the money, the government created a strict legal order of priority for account creation. This pyramid graphic lays out the hierarchy. Legal guardians are at the top, followed by parents, siblings, and grandparents. Once the highest person claims it, the system locks. Nobody lower can open a second account. Each child is limited to 1. So the practical takeaway: if you want that $1,000 for your child, you have to enroll manually. This benefit won't arrive as an automatic check. Mark it down, because next we'll get into how much you can add to the account, how the money is actually invested, and the catches that surprise nearly every parent. Welcome back. In our last video, we introduced Trump Accounts, a brand new tax-deferred investment account for children that opens for funding in July 2026. We covered exactly who gets the government's $1,000 seed deposit: U.S. citizen children born between 2025 and 2028 with a Social Security number, but only if a parent or guardian actively sets the account up. Today, we are going to map out the specific mechanics of that money. We will go through the exact contribution limits, look at where those dollars are actually invested, and outline the hidden catches missing from the viral headlines. Moving past the hype and understanding the fine print is the difference between securing thousands of dollars in tax-advantaged growth and getting hit with unexpected IRS penalties. Parents and relatives can add up to a combined maximum of $5,000 per year for each child. Notice how that initial $1,000 government seed deposit drops in separately. It sits on top, meaning it doesn't eat into the $5,000 you're allowed to contribute. Employers can also chip in up to $2,500 a year for an eligible employee's child. The exact rules on how that fits with your family limit are still being finalized by the Treasury Department and the IRS. Here is what happens if your family's combined deposits overflow that $5,000 line. The IRS treats that as an overcontribution and applies a 6% penalty on the excess money every single year until you fix it. Because of this strict penalty, open communication is an absolute financial necessity. You have to coordinate carefully with the child's grandparents or aunts and uncles so you don't accidentally cross that line together. Many assume the government places this money into a standard bank account, but the truth actually involves the stock market. By law, these funds must be invested in low-cost index funds or exchange-traded funds that primarily track United States companies. Think of an index fund like a variety pack. Instead of placing a risky bet on one single company, the account buys tiny pieces of hundreds of major American businesses all at once. Looking at this 18-year line graph, you can see the reality of market investing. While the historical trend points upward, the balance will inevitably experience dips and peaks along the way. Parents have to adjust their mindset. This is a long-term growth investment, not a guaranteed savings balance. Knowing that helps you avoid panicking during downturns. You cannot withdraw funds early for emergencies. It stays strictly locked until age 18. Second, tax-deferred isn't tax-free. At adulthood, it switches to retirement rules, meaning they'll pay taxes and potential penalties on the growth upon withdrawal. The final catch is the setup process. Enrollment is not automatic. To claim that $1,000 seed deposit, parents must take proactive steps starting in July 2026, either by filing IRS Form 4547 or registering on the official government portal. These 3 restrictive guardrails prove exactly what this program is. It's a highly structured financial tool designed strictly for building wealth over the long haul, rather than free cash you can spend today. This checklist outlines your immediate battle plan. Mark summer 2026 on your calendar, coordinate your family's contribution limits to avoid that 6% penalty, and prepare to file Form 4547. Taking the time to do a small amount of paperwork now secures a $1,000 market-invested head start for your child's future. As you can see on this text card, this video is for general educational purposes, not personalized financial advice. The program is new and still evolving, so always check irs.gov or consult a qualified professional for your family's specific situation. True financial empowerment comes from understanding exactly how these accounts work before you sign up. If this helped clear up a confusing topic, please subscribe to the Easynance YouTube channel. We translate complicated money and tax news into clear, plain English answers to help you keep and grow more of your money. See you in the next one.